And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show this morning. Of course, it's Tuesday. Yesterday, bond market was closed. Stocks were open yesterday, so a little bit of lighter trading yesterday for Columbus Day. We also had our interview yesterday with Daniel LaCalle, PhD economist, portfolio manager. Had a long, broad discussion about a whole variety of things, from global economies to cryptocurrency to a variety of things. So if you haven't seen that interview yet, I certainly encourage you to go by the website, realinvestmentadvice.com. Click on that link on our YouTube channel to watch that video. I think you'll enjoy it. Again, it was a really, really good conversation. We've got a lot of interviews coming up for the rest of this year that I think will help also on a lot of different topics we'll be covering. Just bring in some different perspectives for you as well. So we're trying to broaden out the show a bit for you. But today, of course, is Two Dads on Money. So we're going to be talking a little bit about annuities, kind of the good, the bad, and the ugly about those. We had a lot of questions about annuities and really a lot of misunderstanding about what annuities are and how you should use them as a tool within your kind of your financial plan. Whether you're young, old, in between, doesn't matter. There is a place for annuities for you, but you have to use them properly. So we'll kind of go over some of those things today. Outside of that, though, economic data has been fairly quiet. We haven't had much data because of the government shutdown. That government shutdown now expected to go longer than 35 days. So why is that number important? Well, that was the longest government shutdown we've had, was 35 days, and that was back in 2018 when we had that shutdown then. That went 35 days. And of course, lots of hand-wringing. Chuck Schumer out today saying, hey, you know what? The longer this goes, the better off we are. You're probably right, Chuck, because nobody cares the government shut down. I mean, have you not noticed the market, Chuck? I mean, market's doing just fine other than a little wiggle on Friday. Government shutdown really hasn't mattered a whole lot, at least so far. Yes, we are certainly lacking some economic data, but markets are figuring their way around that. So again, despite the fact that we're in the middle of this government shutdown, it's probably going to drag on longer. The eventual end of this is that an agreement will be reached, and then funding will get done, and everybody will go back to work. That's how these things turn out. So again, and the markets know this now. Markets have been through this so many times. They're just like, yeah, whatever, yawn. It's a government shutdown. But we've got some other things to be concerned about here near term about the markets, and that's been this increase in volatility. Since we had the interview yesterday, we didn't get to really touch on Friday's meltdown. Very sharp sell-off on Friday because of just really no reason, right? It was kind of pegged on this idea that Trump's going to retaliate against China with 100% tariff. But we've been through this story before, and again, as we've talked about a lot, that all you need is some kind of unexpected catalyst. When you have everybody chasing asset prices higher, you just need kind of an unexpected catalyst to cause that reversal. And we saw that on Friday, and it came across a lot of different assets. Bitcoin was down, stocks were down, bonds rallied sharply. So again, we kind of saw this risk-off rotation occur very quickly. And importantly and technically, and we're going to get into this here in 1 second, some things did change on Friday. And so let's talk about what you need to know before the bell this morning. So on Friday, we had this very sharp down candle, as you can see here, and that took us right to the 50-day moving average. Now, the good news is that yesterday, buyers showed up and they bought the dip at the 50-day moving average. So that is good news. And so the market rallied nicely yesterday, coming off that test of the 50-day moving average. So we now have an initial test of the 50-day moving average. Here's the things we're watching for today. Markets are looking to open down this morning. Now, the reason this is important is that we tested the 20-day moving average from beneath yesterday. So we broke the 20-day moving average, which has been this running trend line that we've seen here for the last several months. And again, as we were talking about just on Thursday, Thursday or Friday morning, Thursday morning, we were talking about this, is that if you take a look, this market is, and I'd said that this market has just been kind of consistently kind of testing these 20-day moving averages this whole way, and every time the 20-day moving average was bought, until Friday. And on Friday, we broke that trend of support at the 20-day moving average. So now we're testing the 20-day moving average from underneath. So the problem with the sell-off this morning is that we need to get back above that 20-day moving average here pretty quickly if we're going to hold this trend that we've been in. If we don't, and the market sells off today and we wind up taking out this 50-day moving average, there is some support right below this, but we're going to be talking about the 100-day moving average, which is currently right around 6,300, 6,310. And then below that, we don't want to be talking just yet about the 200-day moving average, which is closer to 6,000. So there is some decent downside risk here that you do need to be paying attention to. And we saw a lot of that selling pressure in AI-related stocks on Friday. Of course, those have also been some of the biggest beneficiaries of this recent rally, particularly in the smaller and mid-cap space. We've seen a lot of money piling into those areas, and that's been a really, really good trade. But again, a lot of those stocks are really overbought, very extended. We saw a bunch of money coming back into those types of stocks yesterday, Oklo, Applied Technologies, etc. Those had really big rallies yesterday. But again, that was kind of a reflex trade here. Retail investors stepping in, buying those same type of stocks over and over again. It's like, oh yeah, I buy this every time it dips and it goes back up. That may be working right now. We'll see if that carries through. But again, if we fail to get back above this 20-day moving average by Friday, we're going to run a bigger risk of coming down and testing that 50-day, potentially breaking that 50-day moving average. And that's going to set up a little bit of a different environment here for a shorter term correction, where, again, we've talked about previously this kind of 3 to 5 to 7% correction would not be a surprise. And that would certainly get us down here at least to the 100-day moving average. And that would be kind of that initial kind of test zone for a reset. But again, pay attention to this. Now, the good news sort of behind all this is that, we had this very big overbought condition in the markets. That was all reversed on Friday. So we worked off a lot of overbought conditions on Friday, rallied a bit back yesterday, still on a MACD sell signal here at a fairly high level. So again, there is still some pressure on the overall markets, but again, that kind of clearing process on Friday, we saw a lot of liquidation kind of across the board in stocks and Bitcoin in particular. Lots of liquidation there. Took out in Bitcoin in particular, you took out every stop loss in Bitcoin. And particularly when you get into the altcoins that were kind of trading very kind of on a very speculative basis, a lot of those went to zero on Friday initially. So you just saw a complete wipeout. Margin, a lot of that margin leverage was taken out. A lot of all the stop losses were cleared out on Friday. So again, you saw just a big reversal there in kind of the crypto world. So again, we'll see what happens here. But again, just be a little bit cautious here. We were talking here over the last couple of weeks, take profits, rebalance risk, blah, blah, blah. We've just kind of been saying that for a while. It's like, yeah, we hear you, Lance. We hear you, take risks, take profits. Yeah. This is why. Because this happens. And this is why you want to manage that risk. And again, we're not through this just yet. We had that initial sell-off. We had the initial reflex rally. The question is what happens next, and we'll kind of be watching that over the course of this week. Again, markets are going to open lower this morning, and so we'll kind of see how this plays out today. It's going to be led today on the sell-off by those same stocks that were leading on Friday as well, kind of in that same technology space. So again, just be a little bit cautious here, but that's what you need to know before the bell this morning. We'll come back, talk with John Penn about annuities. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Brent's just having all kinds of trouble this morning. So
He was up late remodeling. He's done some great work.
I know, right?
Yeah.
Just overnight, brand new set. So, morning, John. How are you?
Good.
Awesome.
How are you?
I'm good. I'm good. But we're just giving Brent a hard time this morning. But welcome to our new kitchen. This is actually my kitchen. No, it is not. Actually, I'm gonna take a picture of my actual kitchen at home just so we can use. You have to take one of yours.
I'll
too.
take one of mine.
Yeah.
After we clean it.
Yeah.
It always looks this way, right?
Yeah. Mine right now, my whole kitchen is covered in sourdough bread making stuff. So
okay.
It's my wife's been at it lately. So
that is a process, from what I understand.
oh, it is. It is an entire thing. It's like raising a kid, and this is why you have to name your sourdough starter, because it takes constant feeding and care. As you can't let it go because it'll die on you, but you got to just keep taking care of it. I was like, so you gave up animals for sourdough.
So you're nurturing and talking to this dough, and then all of a sudden you got to consume it. It's
exactly,
nice.
exactly. Anyway, funny story over the weekend. So my daughter, my daughter is at Baylor. It's her first semester at Baylor, right? So she's trying out all the new stuff at college, and so she signed up for intramural flag football. Yeah. So here's the problem. She knows nothing about football. I mean, she knows nothing about football. She's never even touched a football. In fact, so she signs up for this, and so they've got to get at least 7 people to sign up with them to have a team. And so she goes and recruits a bunch of her girlfriends that she's met in college. Now, my daughter was a dancer for a very long time, so she kind of rotates in a cycle of girls that were all in dance or are in dance, etc. And so you can only imagine what's happening now with this group of girls. And so she rounds up 7 girls, and they're going to go practice, have their first practice, because their intramural games are coming up, right? So they're going to go practice. So they're all heading out to the place to go practice, and they all realize that they don't have a football. So
I need one of those. Yeah.
So something you might need if you're going to practice football is actually having the ball. So they find a guy. So there's a guy walking with his buddy on campus, and they go, "Hey, do you happen to have a football that we could borrow? Because we're going to practice for intramural football." And they go, "Oh yeah, we're on that too." So they had boys and girls. He's like, "Yeah, we're doing that too." And she goes, "Well, how many people do you have on your team?" He's like, 15. And she goes, "Why do you have so many people on your team? They only told us we need 7. Well, yeah, you need 7, but are you going to play both offense and defense for 40 minutes? And so now she's starting to think, right? She's going to be running around this field for 40 minutes. Anyway, so they go back. The boys are really nice. They, yeah, absolutely, we'll get you a football. So they went and got him a football. And they tried to practice. Now, so they had their practice. So my daughter comes home this weekend, and she's telling me about this practice. Now, somehow, magically, she became quarterback. So my son and I take her in the backyard to teach her some basic plays about being quarterback, and so she can do this, and try to teach her how to throw a football. So this was Saturday's venture. So yesterday, she gets back to school, and she calls us. They have practice. And so it's her and her team. They go out and they go practice, and she's now been kicked off as quarterback.
Oh no.
And I go, "Okay, this is great. So what position you're playing now?" She goes, "I don't know what position it is, but I'm the one that runs around. They throw the ball to you." And I'm like, "Oh, you're a wide receiver." Got it. So we're going to see how this. I'm going to keep you updated. The first game is coming out like in a couple of weeks. And I'm seriously thinking I'm going to have to drive to Baylor to go watch this football game. So, yeah, it's gonna be priceless.
Do you know the name of their team?
Not yet.
Oh, see, we got to know that too.
I know. They haven't named their team yet. That's
okay.
it. So
All right.
they're about to work on that. Yeah. So I'm thinking the Baylor Bombers might be the right name for this one.
The Baylor Bears. Is this the Bad News Bears? I don't know.
It could very well be. So anyway, it's we'll see if they get past their first game or not.
Good for them, man.
Yeah.
I bet you will be surprised. I bet they tear it up this year.
I bet yeah. We'll see what happens. But anyway,
I love it.
Anyway, funny story this weekend. Anyway, so annuities, the good, the bad, and the ugly. So we get lots of questions, and I just actually had a series of questions just recently about different types of annuities, and In particular, are annuities a good investment? And particularly in volatile markets, they tend to get a lot more notice, because when markets are going up and down, and you'll hear these advertisements on the radio or whatever, it's like, hey, get all the upside of the market with none of the downside, just buy an annuity. And there is not a lot of truth to that statement. There's some truth, but there's a lot of misnomers about some of these statements that are made. And yes, you can limit downside risk, but with any asset or with any investment, right? If you want to limit your downside risk, you're going to give up your upside as well. And and this becomes, and the problem with annuities is that they tend to be expensive, or can be expensive, which is okay. There's nothing wrong with the expense. A lot of people look at expenses like, oh my gosh, I don't want to buy that because of the fee. Be real careful with that. Just because you pay a fee for something doesn't necessarily mean it's a bad thing. What Wall Street has done is saying, oh, you've got to have the lowest fee for everything. Well, what that's done is driven everybody into passive investing to buy an ETF because that's the low fee, but you wind up giving a lot of other benefits away as well. So again, it's just important to understand that fees are important and they do impact your future returns, but they should not be the only consideration of what you're investing in. So just these are just kind of things to think about. But again, so just kind of, John, what I want to do is just kind of start at the kind of the high level. There's lots of different types of annuities. There's variable annuities, or fixed index annuities. There's just kind of income annuities. Kind of just start out with just kind of an overview,
Sure.
And then we'll just kind of start breaking down. And the key thing here is that annuities get a really bad rap in the industry because they're sold, and people are like, oh, you need to put all your money into an annuity because this is going to be your nest egg, and this is going to protect you, and no matter what. And in a lot of cases, that's a really, really hard argument to make, that you should put all your assets into any one thing. And again, investors do this, and then they find out that there are downsides to doing those types of actions. So again, we never recommend putting all your investments into any one thing. But importantly, annuities have gotten a really bad rap because they were sold, and then people figured out that this really wasn't the right product for them. And again, it doesn't mean that it's not a good product. Annuities are a very good product, but they have to be for the right reasons. And we'll go through those. There's basically 3 reasons you need an annuity, and we'll go through those today. But again, whether you're young, just getting started out, or whether you're midlife, or whether you're late in life, annuities can be a really good asset to have in your portfolio mix, and you shouldn't ignore them altogether. But again, you have to use them correctly.
Yeah, so annuities, like you said, sometimes annuities get a bad rap because they're sold. And annuities are known for being a very high commissionable product. For the representative that is recommending the annuity, they can tend to be a very high commissionable product for the person that's recommending them, right? But I also like what you said about fees, because sometimes as investors, we are so focused on the lowest cost, sometimes you kind of get what you pay for too. So you got to be careful with fees. But just from a very high level, just what is an annuity in general? And an annuity is it's basically a contract with an insurance company. And an annuity, I think of it's like a structure. You put your money into this, and eventually the annuity is designed to provide you with an income stream. It's almost like a personal pension. That's really what an annuity is, right? Like Social Security. That is an income stream that you cannot outlive. That is what annuities are designed to be. They are designed to be almost like a personal pension. They can create a paycheck for you, right? And if used correctly, within the context of your overall financial plan, annuities can sometimes be a very useful tool to have as part of as a piece of your overall investment strategy, not for everything, right? I don't think you don't need to put all of your money into an annuity, because when money goes into an annuity, you're giving up liquidity, right? And so, because you're placing your dollars with an insurance agency in return for a stream of income payments. Sometimes you can turn on those income streams immediately, hence the name immediate annuity, or you can defer this, like a deferred annuity, where money goes into the annuity, and those dollars in there, in my mind, they kind of cook for a while. that money can get invested. You try to grow the dollars when it's in the annuity itself, and then you turn on the income stream, or you annuitize the annuity at a later point in time to turn on that income stream when you need it. So, but to Lance's point, so there's a number of, there's different flavors of annuities. You have fixed annuities, just like the name says, a fixed annuity. It's designed to provide you with a fixed, guaranteed interest rate for a very set period of time. That's either for your life or for a period of time. Maybe it's 10 or 20 years, right? Then there are fixed indexed annuities. Lance alluded to one of those where the performance or the value of the annuity itself is tied to a market index, something like the Standard & Poor's 500 index. This is, you see a lot of fixed indexed annuities that are marketed during times of market volatility, right? Because investors are typically looking for some type of investment structure that they can put their money into, and they can participate in the upside of the market without any sort of downside risk. So fixed indexed annuities can be somewhat attractive in the right market environment. They sound very attractive, but you have to watch for these because you're going to be capped on the upside. So maybe like this year, the Standard & Poor's 500 index is up, what, about 14%? 12. So after Friday. So after Friday. So the market's up, let's say 12% for the year. Well, in a fixed indexed annuity, if your money is tied to the Standard & Poor's 500 index, you're not going to get all 12%, right? The annuity company won't give you 100% of the upside. They're going to cap you. Maybe you receive 3, 4. Maybe your cap is, hey, if the market's up 12, the most that we're going to give you is 5, or the most that we're going to give you is 4, or the most that we're going to give you is 3.5. It depends on which index you choose within the annuity itself. So they're going to cap you on the upside, but if the market goes down 12%, you're not going to lose any of your principal, right? So sometimes a fixed indexed annuity can be a way for you to participate with the market without it having any sort of downside loss. The only issue is when you put your money into the annuity, you try to get it out, there's typically a surrender period or a period of time. It's usually about somewhere between 7 to 9 years, where if you want to take money out every year, usually the annuity company will give you, hey, you can take out 10% this year penalty free, but if you try to take out more than that, you're going to start paying surrender penalties. Usually until about year 7 or 9, that's when those surrender penalties go away. So annuities are not liquid.
Yeah, and that's those surrender penalties. And normally this is where investors really get stung.
Yes.
Is they're sold this annuity and then they go, I don't really want all my money in this annuity, and then they go, okay, I just want to get out of this thing, and then those penalties are really steep in the first couple of years. They can be 8-9% of your capital right up front. So again, you go, I want to get out of this. Okay, well that's fine, but you're going to pay a 9% penalty to get out of this. So that's why people really have a bad taste on annuities, and that's why they have a bad rap, is because they get sold this. Again, and look, if a guy, if you meet with somebody and all they sell is annuities, that's what you're going to get sold, right? So just make sure that you're not, working with a plumber that only has one wrench, right? That's
a great analogy.
And because again, it's like the old saying is like, if you only have a hammer, everything looks like a nail, and that's kind of what happens with some of these companies that all they sell is annuities. That's their solution to every problem is, oh, here's an annuity to solve that problem. And then what happens is people get sucked into these things, and they do pay a big commission, so you can understand why. But they kind of get sucked into these things, and then they realize, oh, now I'm stuck in this for 5, 6, 7 years before I can get out with just a lower penalty, not even a penalty-free basis.
Right. So that's some of the common questions that I receive when I'm visiting with folks, where maybe an annuity was recommended to them by a different financial provider. It's, hey, I didn't realize that there are these surrender penalties. Hey, I didn't realize that I really don't have access to my funds right now. And so you just really want to make sure you understand before you put your money into a structure like this, that you understand how it works, right? And that's also a reason why you don't put all of your money into annuities. But if used correctly, you've planned for these, they can be a useful tool. More on that in just a moment. So different flavors of annuities. There are variable annuities, just like the name says, variable. The dollars that go into the annuity, they're going to vary because typically you have a portfolio of underlying mutual funds that you can invest in, almost like a menu that you would see in your 401k plan, right? And you can invest that annuity to be aggressive, conservative. The goal is to fund the annuity and have that money grow over time, so that way you annuitize it later, and that's when you turn on your income stream. But with a variable type of annuity, it's not like a fixed indexed annuity where you're capped to the upside and you have no downside loss. With a variable annuity, hence the name, you've got the chance for principal erosion in there, because what's supporting the dollars in your annuity is a portfolio of mutual funds, right? So, and get a lot of questions too around immediate annuities, where you fund this annuity with a single premium right up front, put the money in, and the income stream starts immediately. And that income stream is typically based on your life, and there's different ways to structure the payout on these. So if I was looking at an immediate annuity and I put my deposit, I funded this annuity with a premium, if I want the highest payout possible, I'm going to tell that insurance company, just base this income stream off my life only, right? But the issue with that is, if I could get one payment and then I go step out onto I-10 out here and get run over by a bus, that income stream is gone, right? So I could also tell the insurance company, we'll base that income stream off my life and a survivor, so that way, if heaven forbid I predecease my spouse, my wife can still receive an income stream for her lifetime. Now, that income might be less because they're covering two lives, not just mine. So there are different ways that you have to look about how are you going to start receiving these income flows from these annuities, because that decision alone is a very important one, especially if you're married. This really should be a joint decision with you and your loved one, right? Bear with me here.
Yeah, and I think the key kind of things that we're going to do is we're just kind of explain the different different flavors of annuities that are out there. And we'll start talking about here in just a second, because have you gotten through all of them? Or
the last one is called a MIGA, or a multi-year guaranteed annuity,
yeah.
And those typically have a period of time of 5 or 7 years, and then after that 5 or 7 year period, you can turn on the income stream, or maybe you can do a 1035 exchange into another one if you want to avoid taxes. You can kind of do that on all these different annuity structures, but that MIGA, the multi-year guaranteed annuity, is kind of the last flavor.
Yeah, and so the question is well, okay, this is great, but why do I even need one, and why would I want one? And and so for instance, there's as we were talking about these different types of annuities. You've got to be careful with what's promised in a lot of cases, and John knows this as well. Is like, you'll see these annuities that guarantees, like, you get a guaranteed 7% return,
right.
And you got to be really careful with that, because you don't really get a guaranteed 7% rate of return. And what I mean by that is that there's actually two buckets of money. There's your bucket of money that you put in. So let's say you put $100,000 into this annuity. I'm going to put my $100,000 in. I'm going to guaranteed 7% for 10 years, right? So that's way better than my goals. I'm really good, so that's fantastic. Be real careful with that. There's two buckets of money. Your money goes into the $100,000 that you invested, and that gets invested in the markets. And that market's going to go up or down over the next 10 years. And then there's this other bucket of money that's growing at 7% a year, compounding. And you're like, well, why are there two buckets? I only put in $100,000. Well, this is how the annuity company gets you. So at the end of 10 years, they look at that and you say, well, let's say we go through a secular bear market period like we did in 2000. So for 10 years, your money makes basically no money. And you go, okay, well, that's okay, because I get the 7%, right? So just now, at the end of 10 years, I'll just take my whole lump sum, just give me my $100,000 plus my 7% compounded rate. I'm in really good shape. And the insurance company says, yeah, one second on that. You're going to have to take, yes, you can have that bucket of money, but you're going to have to annuitize that stream for the rest of your life. So you don't actually get the 7% as a lump sum payment. You can take out lump sum at the end of the 10 years. If at the end of the 10 years, your bucket of money did better than 7% a year, you can take all that money out at the end of the annuity and you're good, right? So just pay your taxes and move on down the road. But if you didn't and you want that 7%, you've got to annuitize it. So again, this is what we're talking about earlier, is that you've got to really read the fine print on these annuities, because there's lots of little tricks and traps that if you're not careful, the end result is not what you think it's going to be.
Yeah, and I've seen a number of different annuity illustrations where an annuity illustration is put in place, and what an annuity illustration is used to try to forecast. Okay, well, if you fund an annuity with so much premium either upfront or over time, and then the annuity company will, like with a fixed indexed annuity or even with a variable annuity, something that's tied to some underlying market performance. They'll try to forecast what this annuity could potentially be worth before you annuitize it, you turn on that income stream. And sometimes those forward-looking growth projections are very aggressive, right? So what if we don't have a market that has historical returns like we've seen up to this point, right? So I would say if you're having some annuity illustrations run, I really wouldn't base the forward-looking returns off historical market returns. I would ask the annuity company, I would look at this on what's the worst case? Or hey, if we have more conservative returns on a forward-looking basis, really how would this look for me, right? Yeah. Because if for some reason, if that annuity company thinks that you're gonna hit 8, 9, maybe 10% a year, a couple years and you don't hit those returns, guess what? You're gonna be in for a real surprise when you go to try to turn on that income stream. It's not gonna be as lucrative as what it was positioned to be.
Exactly.
Right.
So, all right. So that's the good and the bad news. So why would you need an annuity? And particularly if you're young, why would you need an annuity? Well, I've kind of laid this out for years, but in my opinion, again, John may have some other ideas as well. Excuse me. But there's 3 reasons that you need an annuity. One is that you are in some type of business, like you're a business owner, where you have bankruptcy risk. Having an annuity is a really good thing. I have and just full disclosure, I have an annuity for this reason, because when I first started in this investment business, and this was in one of my previous companies, but when I started that business, I was like, hey, if this business fails and I have to file for bankruptcy, I want to have some assets that are protected against bankruptcy, and annuities can fall into that category. When Ken Lay was the head of Enron, the CEO of Enron, he shifted all his money into annuities before he passed away. As Enron was blowing up, he died of a heart attack, but all his money was protected from the Enron bankruptcies because it was in annuities. So if you're young, starting out, and you're starting your own business, which I applaud you for that. That'll be great. You should definitely take advantage of capitalism, start your own business. It's the best way to have unlimited income in your life. But think about having an annuity take some of your savings and set it aside in an annuity just in case the business fails. That way you've got some protection of assets. So business bankruptcy risk is a good reason to have an annuity. Another reason to have an annuity, and this is also a reason why I have an annuity, because we're in a sue-happy business. So if you're in a business where there's a high potential for litigation risk, like the securities business or like being a doctor or whatever, having your money in an annuity makes a lot of sense. Again, protection against lawsuits, protection against, those assets are protected against disbursement through a forced liquidation. Then the last reason, so if you have bankruptcy risk, sue-happy business, third reason is that you need a guaranteed income stream. And so if you're getting older now, and so kind of bankruptcy risk early in life, litigation risk midlife, depending on what you're doing, and kind of late life is now I'm moving into retirement and I need a guaranteed income stream. We talk about what's called the Alpo diet. So if you think about what it takes for you to fund your life as it is, pay your house note, pay your utility bills. I mean, just basically keep the lights on, and all you've got left is Alpo to eat, right? I mean, there's no food for money. What's that number, right? That's the Alpo diet. So that's $3,000 a month, $4,000 a month, whatever it is. And so your Social Security is only going to pay you $1,800 a month. So you've got a gap to get to $3,000 of say $1,200 a month. Well, you can go buy an annuity, like John was talking about, that will guarantee you that $1,200 a month, for the rest of your life, as long as you live. So you'll always have those basic income needs met, and an annuity can be really good for that. But those are kind of the 3 reasons that I look at. Is like, okay, if you fit into one of those buckets, an annuity could really make a lot of sense for you.
Yeah, it's see a lot of folks that are in those businesses where they're subject to litigation or being sought after. They're have a high likelihood of being sued. That annuities can be a very useful tool to provide protection from creditors. That last point that you made, really, the income stream. So there are a number of clients that I work with where they really do not need an annuity. They don't need one. And we always look, at least at our firm, whenever we are exploring whether an annuity makes sense for somebody or not, we take an approach where we look at the client's overall holistic financial plan. Let's look at all of your different moving pieces, all of your investable assets. And if we plug an annuity, if we model an annuity stream into your plan, is the outcome of your plan better or worse than if you did not have the annuity at all? In other words, is one approach better than the other when it comes to looking at an annuity within a plan? And there are a number of clients where their financial plans are extremely healthy, and we can stress a plan for, hey, what if the market goes down? What if equities come down by 20, 30, 40%? How does your plan look? What if inflation runs higher than expected? How does the health of your plan look? What if big question that I get, John, Lance, what if Social Security is means tested, or what if my Social Security benefits reduced by 20 or 25%? How does my plan look, right? So we can really stress a plan. We can what if my expenses are higher than what I anticipate, right? So we can really stress a plan, and there are times when we build in an annuity stream, an income stream, through those various, like how we stress a plan, sometimes with that regular fixed income stream from an annuity, the plan looks much healthier. So then, guess what? Maybe it makes sense to weave in an income-based annuity for a portion of the client's overall assets. But there are times where the math says, you know what, Lance, you don't need an annuity. You're no matter what we throw at your plan, no matter how we stress it, you are in great shape. So the math is telling us you don't need an annuity. But then there's an art and a science to this, where sometimes clients will say, you know what? Hey, I just want to know, John, I want to be able to sleep well at night knowing that no matter what happens, if it really hits the fan out there, between what I do receive from my Social Security, if you're fortunate enough to have a pension, hey, I just want to make sure that my basics are all covered. So I need an annuity to, in addition to my Social Security, what I'm getting from my pension, I want to have an income annuity that fills that gap, so I know that no matter what happens out there, that all of my basic living expenses are covered. Guess what? If you just sleep better at night knowing that that is the case, then let's explore building an annuity into your overall situation. But we really want to plan for this. I think so many times, annuities are just sold, and they're sold out of fear, right? So you don't let somebody sell you an annuity out of fear. You really need to take a look at your overall big picture situation and how does an annuity really fit, and what does the math tell you? Does it make sense? Sometimes the math says you don't need it, but there is something to say that there's something to be said about wanting to sleep well at night too.
Yeah, no, exactly. And there's a couple of comments in chat right now too that are worth addressing. One is like, why would I buy an annuity where I can just invest money in the markets? I can make 15 or 20 or 100% on the markets, whatever. And that's true, except for days like Friday. There was a really sad article over the weekend that this young kid, I think he was in his early 30s, they found him inside of his Lamborghini, had committed suicide because he had lost all his money. He was a crypto mogul and had lost it all on Friday. Just a single crash wiped him out in a single day. So that happens. And that happens in markets all the time. You can have very, very big setbacks in the market, especially when you're speculating in markets like we're doing now. The speculation's running rampant. People are taking on way more risks than they realize. This is all going to end badly for a lot of investors. Having some money in an annuity will protect you against that. And again, we're not saying, do not mistake that we're saying that you should have 100% of your money in annuities. We're not saying that at all. But again, I have what's called start over money in an annuity. If everything goes to hell in a handbasket, my wife is protected. I can start over, and I've got enough capital there to start a new business and get things running, right? So I've got the ability to survive while I get back on my feet if everything goes wrong all at once, and hopefully that'll never happen. Another thing is like, well, just put all your money in a trust. That way nobody can get to them. Trusts are good, but they're not bulletproof. As bulletproof as annuities. I have seen trusts get busted for a variety of reasons. If you don't maintain your trust properly, you can pierce the corporate veil. That's very easy to do. And depending on if your trust is being sued for one reason or the other, depending on the judge that you get, if you get judges that have a bias, and there's lots of them out there, they will allow endeavors into that trust. So again, they are pretty bulletproof. I'm not saying that you shouldn't have a trust. I have trust, for my assets. I'm just telling you that they're not 100% bulletproof. Annuities are, by law. They are protected. So again, don't sleep on annuities in terms of some asset protection. They can generate income for you. They can create returns for you. They can grow your capital. Yeah, they're not exciting. They're boring. They're not chasing markets. But again, we're not saying we're not saying that that's the investment to use. We're saying think about your security and your safety, and maybe an annuity is not for you. Again, I gave you 3 reasons why of people that need annuities. You may not fall into one of those categories. Another reason to have an annuity is that you make so much money that you can't really contribute to a 401k plan at work. There's means testing and for 401k plans it works. And so if you have a smaller company where you have some highly paid executives and you have a lot of workers and they don't contribute to the plan, as a highly paid executive, you can get kind of phased out of your contributions to your 401k plan. Feel free to jump in if I'm wrong.
No, you're right. You're great. Keep going there, Lance.
So an annuity allows you to shove some money away into a tax-deferred product if you can't use an annuity. If you can't use a 401k plan at work.
That's right.
So highly compensated people need annuities as well. So again, there's just want to reiterate, we're not saying put all your money into an annuity. Do not walk away from this conversation and say, oh, Lance and John, we're selling annuities this morning. That's not, we're just trying to educate you on, because we get a lot of questions on annuities, about the benefits of annuities. And we've gone over the drawbacks as well. There are drawbacks to annuities, and you need to be aware of them. But again, don't sleep on them either and just dismiss them out of hand because you heard that they were expensive or you heard that the returns were low, whatever. Don't sleep on annuities for particular reasons that they may actually be a very, very good safety net for you.
Yeah, I think the goal today with the conversation is I think annuities tend to always get a bad rap. Kind of annuities tend to be a kind of a 4-letter word in the finance industry, and there are pros and cons with these, right? I mean, if you really need to keep your money liquid, and you need to make sure that you have access to those funds when needed, an annuity does not make sense for you, right? It just doesn't, because annuities are illiquid vehicles. They are just illiquid. There are ways you can get money out, but if you're not careful, you're going to pay some surrender penalties, as we alluded to earlier. So there are times, and a lot of folks that I work with, they don't fit. Annuities don't fit for their situation, but there are times where it does fit. You just want to make sure that you just really understand these before you put your money in, right? So, and if used correctly, annuities can be a very good tool, but it has to be for the right person and it has to be for the right fit, right?
Exactly. Well, and again, one of the questions in chat right now is, are there inflation-adjusted annuities?
You can fight against inflation by investing in mutual funds or underlying investments that are designed to grow within the annuity itself. But I think there are annuity structures out there where you can almost add like an add-on to it, like a rider, where you could add on like a cost of living adjustment rider, where the benefit can adjust for inflation moving forward. There are annuity structures out there where if somebody is concerned about long-term care or higher medical expenses as one gets older, you can add features to annuities where if you cannot perform, let's say 2 out of 6 activities of daily living, that there's a feature that you can turn on with the annuity, and it can provide some long-term care assistance as you get older. So it's like when you buy a car, like with annuities, you can you can add, certain objects to them, but they're going to pay a little bit more for that, right? So if you wanted to add on a long-term care rider or a cost of living or inflation rider to that annuity, you're going to pay a little bit more for that. But yes, you can. These are things that you can add on to the annuity as part of the overall structure if it makes sense for you.
Yeah.
Yes.
And again, so another comment was you could use a bond ladder to build your own annuity, and that's a true statement. You can do that. But again, you lose the asset protection issues. And again, so if you'll notice, the big part of our conversation today was not really about return. Because again, if I just need to build an income stream for retirement, I can do that with dividend yielding stocks and bonds. Absolutely correct. But you'll notice that when we were talking earlier about do you qualify for an annuity, they were all around risk that were uncontrollable. Bankruptcy risk, risk, lawsuit risk, income, guaranteed income needs. You've got to have that income or you're basically on the street starving.
Yeah.
Those are the types of risk that you're trying to hedge off, and a stock bond portfolio won't do that for you. A stock bond portfolio won't protect you against, bankruptcy risk or lawsuit risk unless it's all in an IRA. Right now, if your money's all in IRAs, then you've got bankruptcy protection there. But if you've got an investable account with a big chunk of your money in it and you're sued, that's going to be all up for grabs. So again, an annuity can help you offset some of that risk.
Yeah, and now there were cases when during an interest rate environment where interest rates were really low, and if bonds weren't paying much and you really needed an income stream, then as part of an overall diversified portfolio, maybe you have some bond exposure in your portfolio for balance, right, for diversification purposes. But then maybe depending if a fixed annuity is paying you a more attractive rate, or even a multi-year guaranteed annuity, or what they call a MIGA, if that is paying you a more attractive interest rate than, let's say, what a bond ladder would generate for you, there are times in a very low interest rate environment that an annuity structure like a fixed annuity or a MIGA could be used as a bond alternative, right? So there are ways that you can use these to help, just supplement income from when you look at this from an overall portfolio standpoint, right?
Yeah. So good question here. Are annuities protected against divorce attorneys?
That's a good question.
Depends on how they're set up.
Yeah, it would depend on how they're set up.
So the answer could be yes or no. So if the annuity is purchased during the course of marriage, and is used and joint assets are used for the purchase of that annuity, no, that is not going to be protected in the divorce settlement. That'll be, and especially if you live in a community property state.
Yeah.
If the annuity was purchased prior to the marriage, then yes, that would be separate property.
It's your separate property.
Yeah. So, that's a yes or no question. So it depends on how it goes. Go ahead.
So great point along those lines around thinking about just divorce or protecting your loved ones, or if you're trying to keep money from your loved ones. Sorry, but with annuities. So especially if it's an IRA, any type of annuity structure, typically you can designate beneficiaries on that. So just make sure that your beneficiary designations are up to date, especially if your annuity is within an IRA. And something else too for annuities and IRAs, this is that time of year when if you're 73 years young or older, you got to take out required minimum distributions. If you have an annuity inside of an IRA, you still have to make sure you're counting those assets as part of the calculation for your required minimum distribution. Yeah. So just wanted to mention that too.
Yeah. And look, I mean, if you're young and you've got assets and you're about to get married, make sure and label those assets. Go change the name. You can change the name on your account anytime you want. And just before you get married and you've got, say, an investment account, go change the name on that account to, the separate property of your name. So that is labeled separate property before you go into the marriage. So that kind of helps.
Keep things separate.
Yeah, and you don't want to go into. You don't want to go into a marriage expecting a divorce, right? That's if you're already expecting a divorce going into marriage, you shouldn't be getting married, right? Just that's kind of a big red flag. But we just have to be realistic that, today, it used to be back in my day when we were growing up, divorce was taboo, and today it's like, yeah, you don't like it, just get divorced. It's right easy. So, but there are some definite things. If you're young, thinking about getting married, there are some things you kind of wanted to plan ahead of, particularly if you've got assets going into the marriage, to protect yourself, right? And it's sad to say that, but again, just kind of think about it. Another question here was, I use a single premium fixed annuity like a CD for tax deferral. You haven't touched on that. I never intend to annuitize it.
Yes. What was the question again?
I use a single premium fixed annuity like a CD for tax deferral.
Yeah. So, but they just haven't turned on the income stream.
Right, and he has no plan to do it.
And no plan to do it. I mean, that's another way you could look at annuities too. You fund it. You want the money to grow tax deferred, because you're not going to pay tax on that until you annuitize or turn on the income stream, and then depending on what the term of that annuity is, then you could either exchange that annuity. You could do like a 1035 exchange into another one, so that way you don't pay tax on the money that's in the first annuity. But yes, so kind of like a multi-year guaranteed annuity or a fixed income annuity where you do have that income stream turned on, and you're getting income payments from it now. That's another way that you could. It's very CD-like to fund that annuity, but not turn on the income stream. You're just earning interest.
Yeah, and I guess the question is really what's the intent, right? So if I'm just putting some money there and I'm just going to leave it to my heirs, that's fine. But other than that, if you're not using the income stream that it's generating, it's kind of dead money. It's accumulating, right? It's growing tax deferred, but you just have to plug that into your plan. It's like, okay, why is that there? Why am I doing it? I'm using it to get CD-based returns, when you could do that in other assets that have a higher return structure. But again, are you just simply trying to avoid taxes, or what's the purpose of that? And again, you didn't give me that in the chat. So
yeah, or you just don't want that subject to the whims of the publicly traded markets. That could be a piece of it too, right?
Yep. So all right, I think that kind of covers it.
Yeah, I mean, annuities are so bespoke for everybody. Everybody's situation is unique and different. So I hope this conversation was helpful, just about the pros and cons of annuities. We don't want you to think that annuities are bad. You just have to kind of watch before you put your money into an annuity structure. You just have an idea of how it works, and if you need to get your money out, just know what your options are.
Yep, exactly. So an interesting conversation here. So when we started talking about divorce, right? Everybody's now chatting in the chat about divorce tips. But it's nice to have some his and her money. I absolutely agree with that. My wife has her job. She has her paycheck. I have my paycheck. We put those into a joint account. And the agreement there is that she can spend whatever she wants out of those two paychecks. And then I have other income that comes in that goes straight into our investments, and that just gets invested.
Yeah.
And I control that because she doesn't want anything to do with it. But it gives her, it's important for your spouse to have independence, that they can do what they want to do without having to ask permission. And, but it should be something that is agreed to, and that people are operating efficiently within. And again, there's a big trust factor. My wife and I have a very high degree of trust with each other. We respect each other. We both play on equal fields. And so, I don't really care what she does. And by the way, I came home this weekend and I pulled into my garage, and there are they are literally about 5 feet tall, gingerbread men in my garage.
But we need those.
We needed those.
We need those 6-foot gingerbread men on our front porch.
And so I now have 2 gingerbread men living. I'm just waiting for Shrek to show up, right? So I have 2 gingerbread men now living in my garage for Christmas. So she's so excited. But that's the kind of thing. She can do that. There's I give her the look, but it's completely okay because she's working within the budget that we've already aligned. So, and the goal is to actually save money at the end of the month and have money out of that on top of it that she can then use to pay for vacations or whatever she wants to do. That's all in her control and her purview. But it gives her independence, it gives her control, and it helps. There's 2 reasons that people get divorced. It's infidelity and finance. And if you're having trouble financially, that tends to promote the infidelity.
It does.
right?
Yeah.
So those two are very, very close, tied together. So, if you really want to give your marriage the best chance to succeed, make sure you're financially well structured.
Yeah, and just have open conversations,
Yeah.
right? The most successful, spousal couples that I see when it comes to finance and investing, it's very common within a married couple that one tends to get more into the weeds than the other from a financial standpoint, an investment standpoint, et cetera. But in my meetings, typically both spouses are present, because if something should happen to this person, the surviving spouse knows where everything is and who to contact if they need help. But they have a very open dialogue about money. They both know where all their dollars are and what they're doing and what their rules are with spending, and they trust each other. So there's a lot of open dialogue there. Where I start seeing things running into trouble, or I see some red flags, is when I visit with maybe not both spouses together, but just one, and they're trying to hide dollars, or this is my money, my significant other doesn't know about it, and there's always some trust issues that are forming there, and so if you can have an open dialogue about this with your spouse, it's just going to lead to a more healthy relationship in your life in general.
Yeah, absolutely. All right, that wraps up the show for the day. Hope this conversation on annuities helps at least kind of open you up to the idea of potentially, if you've got risk in your life, that there is a way to hedge some of that risk. And again, we're talking about bankruptcy risk, lawsuit risk, those type of things. Because we certainly encourage you to take advantage of capitalism, but with capitalism comes risk. And so you need to make sure and manage that risk accordingly. So I hope this helps. If you have any questions specifically about your situation, feel free to reach out. You can go to our website, realinvestmentadvice.com, click on the Ask a Question button, send a question. I'll forward it over to John. He'll be happy to help you out and kind of get you pointed in the right direction. But also, while you're there, make sure and send us any question, comments you have. Get our latest blog posts, our newsletters out this morning as well. It's all on the website, realinvestmentadvice.com. And while you're here, be sure and like and subscribe to the channel. We appreciate it very much. And we'll see you back here tomorrow for the Wednesday edition of the Real Investment Show. Have a great day.